Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Senior Technical Analyst with Market Rebellion. And hopefully you had a chance to watch my midweek report where on Wednesday, right at the close, I made some market commentary talking about where I thought the markets would wind up on this Friday afternoon. And as you can see right here from the look of this candle chart on the VIX, we moved right up to that green dotted line, which is, in fact, the line that I drew on Wednesday. I extended my forecast, being that we did hit the target for the VIX at $20.27 right there. And today we hit that upside resistance target. And notice what we see right there. We have what's known as a shooting star. Now, a shooting star is a small body candle that has this long shadow that's at least 1.5 to 2 times the length of the body, and we have that being almost 4 times the length of the body. Now, what does that mean for the VIX? Well, if you look at the candle, that would be bearish for the VIX. We could take out our trading checklist, and I'm going to talk a little bit about that in a second here, but we basically are weighing the signals, the buy signals versus the sell signals, and that candle right there is short-term bearish. Number two, we see a wide divergence from that moving average. That will be bearish based on what we call the rubber band effect. We have a wide divergence from the K and the D down there. That is going to be bearish. And we have an overbought condition on the CCI down below. So if you stack up all the evidence, that is bearish for the VIX short term. So next week, I do believe the VIX is going to turn back just a little bit. I'll put a downside target there of 1995. And then I think we're going to bounce from there. So whether or not I get a chance to put out the midweek report on Wednesday, I'll have to see, because I'm traveling to San Diego for a live event out there. But right now, I'll keep that price target of 1995 right there until next Friday. But giving you a heads up, I do believe that as this moving average starts turning up, like I think it will, that moving average is going to act as support. So we might get a little bit of a bounce off of that and then start to break out through that resistance area. So remember, the VIX is inversely related to the S&P. So what does that mean for the S&P? Well, it means that we could see a slight bounce. Now, we came very close to my target right there on the S&P, which was 402.51. And where did we wind up? Right at that moving average on lower volume. Now, again, taking out your trading checklist, that small body candle is known as a spinning top. We could use a little bit more of a shadow on top with that, but that is taken as a spinning top, a sign of indecision, more neutral than anything. But the drop in volume at the moving average tells us that the sellers are losing some of that momentum. So while we could go a little bit lower to fill that target at 402.51, I think we could see a little bit of a bounce on the S&P Monday and Tuesday. It's a little bit of a change from what I thought would happen based on Wednesday's analysis. Because here, Wednesday, we had that bearish Harami. Yes, it did in fact drop after that, but that was a bearish candle. We have to watch the volume because that is a leading indicator. In my book, the volume is one of the forgotten leading indicators. So after this rally, I'm going to go a little bit further out in time here. I think we're going right back down below that moving average. So this is more or less a two-part forecast like I've done many times. Upside target on SPY of 410.55, then right down below that moving average of 401.72. Now let's take a look at the diamonds. Ticker symbol DIA. It's kind of stuck in a very narrow range. Again, we came very close to hitting that downside target of 335.20. This, in fact, could go a little bit lower and hit that target. And then what I'm going to do here is I'm going to go a little bit lower with my forecast. I think we're going to see that target hit on Monday, and then we could see a bounce right back up to the highs from today and stay right there. So again, initially a little bit lower. It's kind of stuck in this neutral area right here, right around the moving average, but I think we're going to wind up right back up to 338.99, which is very close to where we are right now. So again, to repeat, diamonds a little bit lower on the opening Monday and Tuesday, and then a rally up on the rest of the week before heading lower, right? So it's a little bit different than what we saw on the spiders, But that's, again, all I'm doing for you right here is reading the charts. Now, if we look at QQQ, this one, again, made a hard pivot lower, not quite back down to this level, but definitely a doji right there. And so this is going to be a little bit different. I think the Qs are going to go a little bit lower to touch that moving average, and then a little bit of a bounce. I'm going to do this little ABCD zigzag here. This is something I don't do often, but I'm going to do a 3-part forecast where I think on Monday we're going to come a little bit lower, bounce Tuesday and Wednesday, and then take a hard turn by the end of next week below that moving average. So you could read that little data box there, down on Monday at a 294.63, up again to 300.66, and then a hard turn down to 287.65. And I guarantee you no one in the world is going to give a forecast like that. But that's basically what I teach in our technical analysis courses and through our trade alert services. This is more or less an A to B pattern, right? A to B, pivot at B, forms C. A pivot lower from C winds up with a lower D. It's an ABCD pattern. It just looks like a little lightning bolt, right? A zigzag. And that's the way it looks to me with regard to how the price action is going to shape up into next week. Now, finally, if we look at IWM, which is basically the small cap ETF, we have a slight breach of that moving average, but it closed right above it. So this is going to be another zigzag pattern where I think IWM will bounce. But by the end of next week, where am I going? Right back to my original target right here. Let's see if I can get that to match up perfectly. That's going to be right there. Upside target on IWM Monday, perhaps 192.28. And then a hard turn in this ABCD zigzag pattern to 187.43. Again, very close to what I have here, 186.71. You could even keep that target in place. I'm not going to be able to match those up exactly to the penny because I'm freehanding these zip lines here. But that's what it looks like to me there on the charts. Now, from a geopolitical standpoint here, you can see that this report came out that the annual interest rate payment on our government debt is approaching $1 trillion per year. Make sure that registers in your mind. $1 trillion a year just on the interest on the debt that we've taken. Who's paying for that? Taxpayers. Is that going to help or hurt our economy relative to us moving into a recession? It's absolutely going to hurt us. So keep that in mind. The debt interest payment is rising to a rate that we've never seen before. That is not good for the economy. And if you want another look at this, take a look at what the forecast is showing here from the Congressional Budget Office, right, the CBO, and they're projecting that the debt will significantly increase over the next decade and completely erode into our gross domestic product, the GDP. So again, not good news, something that they're not talking about all that much. Here's another one. I often refer to this over and over again. While credit card debt is increasing, they're going to try to make you think, oh, it's slowing down, but it's still increasing. The personal savings rate is still dramatically decreasing. So the differential between the amount of debt taken on versus savings is the widest divergence that we've seen here in decades, and it's not getting any better. That's a leading indicator as to what's happening with our economy. People are using their credit cards to pay bills and living expenses and such, while their personal savings is dwindling in the bank. That's very serious right there, and we'll keep an eye on that. We'll try to track that at least once a month. Now, again, to reiterate this massive change that we're seeing in consumer debt, they say it rose by 15%. This is according to the Federal Reserve. But if you look at how they're trying to spin that story, they're not going to tell you that was the biggest increase in more than 20 years. They're not going to tell you that part. I highlighted that for you so you get the real truth of what's happening around the world. Now, I'm going to move through these quickly because there's that old saying, don't fight the Fed, right? Well, I said this on Wednesday. It looks to me like the Fed is fighting the Fed. Because Fed's Waller here talking about inflation, he's saying that it's not done. The fight against inflation is not done, and it might be a long fight as interest rates may stay higher for longer. Again, is that going to help our economy? No, it's not. Inflation is not a good thing, and it might look to you as you listen to Fed Chairman Powell speak that, he's turning more dovish, meaning he's focused more on the economy than he is on fighting inflation. But the fact is, we're not going to have a soft landing, folks. What is that term, soft landing? Well, soft landing means that we are going to more or less avoid a recession and be able to pull back and get back on track without any kind of a significant downturn in the economy. And that's not the case at all. In fact, look what the CEO of Bank of America said this week. This came out on the 6th of February, just this week. They are literally preparing for a U.S. default. Now, my personal opinion is that we will not default, but here's the big threat. As we approach this threat and it continues to become more serious, there's a point in time where Moody's will come in and possibly downgrade our debt rating. And that's happened before. If Moody's comes in and downgrades our debt rating, you're going to see the market spiral down. Another thing, this came out, again, through CNN. Look where I have this red arrow pointing right here. They are treating this, Bank of America now, they're preparing as if it were a natural disaster. That's how serious that Bank of America is taking this threat. Now, if you look at, again, what's happening with the fight against the dollar, yet you see here that Saudi Arabia says they're now open to ideas of trading in currencies besides the US dollar. And I mentioned this week after week. I've been talking about OPEC possibly taking currencies based on gold, right, backed by gold, and that slowly the greenback will lose its credibility in the marketplace as a global reserve currency. And again, look at my box down here. This is Saudi Arabia's finance minister saying this, that they are open to trading in currencies besides the US dollar. Now, I say that because once they start taking the gold-backed Chinese yuan or the gold-backed Russian ruble, then we eventually are going to lose buying power and the value of our dollar will continue to drop. And if you take a look at a monthly chart on the US dollar, just look at $DXY, which is the chart that will come up for the US dollar. Look at that on a monthly chart. You'll see that the dollar is in big trouble. Technically, that is. It's still in free fall. So this is a story that I'll continue to report on. Here's another one with regard to cryptocurrency, Bitcoin, and the like. I will be putting the link down here. See the link? I'll be putting that link in the description page. Very, very interesting article on how the central bank digital currency would bring about hyperinflation. And the CBDC, as it's referred to, the central bank digital currency, is about to take hold. And I think that's going to be a transition that we'll see as the Federal Reserve and other Western central banks start to more or less acclimate the general public into thinking that this is going to be a good thing for our economy. I believe that many people are going to resist this. They don't want to be part of a centralized currency where every transaction will be tracked, from a piece of gum to your groceries to what you order online. I think people want that privacy, and I think there's going to be a more or less a big resistance against the digital currencies that are centralized. Bitcoin is decentralized. You may have seen some of the news coming out with the SEC. They're moving more towards regulating the cryptocurrency market, treating it more like a security. So again, I'll find more stories about that and report next week on how that is developing. And as I've mentioned before, the yield curve, now that it's inverted here, it's at the deepest level in this inversion since 1980. This is reported at a Bloomberg just yesterday. This, my friends, as I've said many times, an inverted yield curve is pointing us to a recession. So the thought of a soft landing in my mind is completely gone. This is more like a crash landing that we're facing right here. And if you look at the yield curve and you keep comparing the 10-year to the 2-year and vice versa, they are telling us that we are moving, again, full speed ahead into a deep recession. Now, before I let you go, I want to point something out. Market Rebellion has done a great job putting an educational video together based on my 7-point trading checklist. And if you go right here, where the code scanner is, if you take your camera out on your phone and you just point it at this little square right there, you'll be able to get the link. and find where you can download the 7-point trading checklist from Market Rebellion. I hope to be doing more of these very short educational videos. They are set up in a format that closely resembles what you'll see in a master class. And I'm really enjoying putting out this educational content for our audience because I'm getting very positive feedback, a lot of commentary. Thank you so much for all the comments on YouTube. We are right at the brink of setting a new record for number of views on the YouTube page for my videos and the weekly market report. Your comments actually help drive the algorithms, and your liking and sharing and passing this information on to other people is helping as well to grow the channel. When you share the video to other people who might have an interest in trading or investing in the market, you're helping to educate them, which empowers them to get a leg up or an advantage over the institutional traders that are out there. And again, I have to thank you for that. It's been a lot of fun. Again, I will be traveling on Wednesday. Not quite sure if I'll have the midweek report going out, but I will most definitely have the Friday weekly market report going out after the close next Friday. So you enjoy this weekend and you have a good one. I'll talk to you next time. Bye-bye. There's no more damaging formula than to mix emotions with money. Listen, we're made up of emotions. We have fear, we have stress. The trading checklist helps take that all away. And now, wow, take a deep breath, relax, and enjoy the ride. You might be completely foreign to technical analysis. You may not even know what a bullish engulfing candle is or a shooting star. That does not matter. The great thing about what I'm showing you right now is I'm taking 40 years of experience here and I'm breaking it down to 7 points that you can follow through a trading checklist. Look at any stock, any ticker symbol using the 7-point checklist that I have and determine who is in control of that price action. I'm AJ Monte and this is my 7-point trading checklist.